What's up, traders? This is Ferris with Trade with Tex, and today I'm going to show you guys a quick method for spotting bigger potential pullbacks in the stock market in advance. Now, this is a method that is a little bit more advanced, but I'm going to simplify it for you. And in addition to that, it could help you hedge positions, play the short-term downside, or just know that there's higher risk in the market so you can stay away. Okay. Now, we're going to jump right into it. I know that Trade with Tex members have seen a webinar like this in the past. It's a little more advanced, but again, we're going to simplify. So there are two components to this, right? This is the S&P chart on the daily time frame, and you can see that I have all these big volume bars coming off the left-hand side of the chart. Now, I'll show you how to add this to your chart, but the idea is that when we are losing one of these big nodes, right, support or resistance, and we have this air pocket below, you can see a couple on this already, that will lead to a bigger pullback, right? Or could lead to a bigger pullback. So you know when to hedge or play the short-term downside. Now, the other component that we factored in here is just moving averages. So not only is it price structure, where we are losing a support or resistance level, but also a trend shift, right? And you guys know this. Simple trend shifts are just using moving averages to cross one another to give us a signal, right? The two moving averages that I'm using here are the 8 EMA and the 20 SMA, but you can use any variation of this that you want. You just don't want these numbers too far off of what I have here. So the 8 or 9 or 10, whatever, the 20, 21, they could be EMAs, SMAs. The idea that I have here is that this is an EMA exponential, so it's more responsive, meaning that when price drops fast, this will give a faster signal than if you were to have an SMA as the lower length moving average, okay? Now, if you want to keep it simple, just do 8 SMA, 20 SMA, but you can see that with the recent action, we have a perfect example of when the stock market went for a bigger pullback in a short period of time. Before we move any further though, I wanted to mention that 60% of you are still not subscribed to the channel. If you want to see more educational content, subscribe, click the notification bell as well so that you're notified when we post a new video. And if you want to take your trading further, we have live webinars, live alerts in the Trade with Tex chat. You can sign up in the description below. It's free for a full week. You don't need a credit card. You don't need any of that. Okay? But let's get back into it. Now, here's the example. You can see it based off the recent action. We had an air pocket here on the daily from this area here, 412, down to 400 and then 396, right? This is where we had the bulk of the support. So as soon as the 8 crossed below the 20, that's this pink line right here, this guy right here, crossing below the 20, as soon as that crossed, we have higher risk, right? And it actually confirmed on Friday of the prior week, and then we saw 1, 2, 3, 4, 5 days straight of aggressive sell pressure in the markets, right? Any rally got sold, and we eventually went for lower lows. So this resulted in just a magnet straight down to that support price. And here is the risk if we were to just outline this from this point onward, right? Here is the risk for that first leg down. And for the S&P, that's a full, 7, 8 points for SPY, which is a big deal. That's not a small move. So the way that you spot this, again, is just by looking for that 820 cross down, right? And then an air pocket in that price structure. So where there's a big gap between support and resistance, right? Or support and the next support, okay? So to add this to your chart, I'll show you real quick because I know this can be a little bit more taxing for some of you. If you need to slow the video down or pause it, feel free to do that, but I'm just gonna run through it. Adding moving averages is simple. You just go to the studies, edit studies, and for me, since I have an exponential moving average and a simple moving average, you just type in EXP and then double click moving average exponential, right? Set that length to 8, hit OK. And then for simple moving average, just type in simple, double click and change this to 20. Okay, a lot of money managers use this same variation where they have either the 20 or the 21 as that length for the second moving average, but again, just do what works for you, okay? Now, after you've added those to the chart, it's really simple. You just spot those crossovers, right? We'll show examples of it without the volume profile on the chart so you can see it a little bit better. Crossover right here, cross back down, look at the sharp pullback afterwards. Obviously, this is a more volatile market state. I'm not going to generalize and say this always happens with the 820 crosses, but you can see how sharp that pullback was. Another one right here, sharp pullback. And we didn't actually cross. On this drop right here, we crossed, and it was kind of weird because we had a Fed day, so they waited to dump us until afterwards. But 1, 2, 3, 4 bloody days in the stock market. And then fast forward, a little bit choppier of a market lately, but we still got that big pull. Okay, so we have that component added. Let's take a look at the other one, which I realize for some of you this might be more advanced, but what we're doing is we are adding volume by price, right? So instead of looking at volume bars down here on the chart, we're looking at volume coming out the left-hand side of the chart. So it shows us what price points are going to act as magnets, right? Big support, big resistance. Okay. Now, to add this, you just go to Edit Studies, and there are a couple of little things you have to do, but I'll show you. Volume profile is the name of the study, if you can spell it right. I cannot. Double click to add it, and then under the settings, we're going to change this first input to tick size. Okay. Then we're going to change on expansion to no. This is a big deal. If you don't change this to no, your chart's going to look all kinds of weird. I'll show you. And I'm going to check both of these boxes, show plot names, show input names. See how weird this chart looks? It's not really telling us anything significant because it's all over the place. So if we go back to the studies and edit this to on expansion no, it won't expand to the right side. It'll just play on the chart on the left-hand side here, okay? And for spotting those big gaps in price, right, those big air pockets, works the same way as gap fills, where if there's no volume there, we're not gonna get a lot of decisive movement unless the moving averages cross. So in these instances, we can actually chop around a lot within these low volume areas. But the idea is that if we have a trend signal with it, we'll immediately go to that price below or above for that matter. Okay, so for the S&P, you can see this prime example where we go straight down to that big price point, the point of control as it's called. But typically when you add this to your chart, you can change the colors up, whatever, but it's going to be consistent with the high volume levels that you might already have. So if you use fibs, pivot points, whatever, you'll notice that these levels are consistent with those fibs. They're overlapping because they're based off of that, right? So volume by price, very useful tool. I know a lot of people use it already, but a little bit more advanced for most, okay? Now, once you've added these two to your charts, it's just a matter of spotting instances where they both line up. So if we roll this back, what is kind of difficult here is that this is all based off of recent movement. So the data for this time frame isn't going to be as reliable looking back, but in real time it is, right? On these days, if we were to pull this up, it would be very useful. Okay, so let's look at the second half of this chart. Let's look at from September onward, right? From that most recent crossover over here, as well as the first one that we could spot already. After this big run up for the S&P, we were in no man's land for a while here. And then as we cross down back into this big area, right, we get the 820 cross downward, which is not good because if you look at this, it's good for us because we know what to do, but for the average investor, it's not good. If you look at this, we have this air pocket on the chart, meaning that we can just magnet right back down from this area to here, bare minimum, right? And we can go as low as here. And as you can see, we went down to that first zone, down to the second zone immediately after, and we ended up following all the way down to 52-week lows, but this was the move we were looking to capitalize on and or hedge the risk of. Okay, so for example, if you have a long-term portfolio, as we see a cross back down into this zone and back below support, you can add a hedge, right? Whether it's the S&P short, puts, however you normally hedge your portfolio. Or you can just go and short your go-to stock like Apple, Tesla, anything really. Okay. Now, fast forward, you can see we really didn't get another signal until here. It was kind of a choppy one. We're around that key volume node, but we still pulled back to this guy, right? We have that air pocket coupled with the signal. We can check both boxes. there's the pullback. And then fast forward, we can see the most recent one, which we already took a look at. Here's that 820 cross, right? And then here is the fast drop off. Normally, because we're looking at the daily chart, right, we're looking at 1 to 2 candles to start confirming this. However, this usually lines up on the weekly time frame, meaning that when this signal confirms, usually we are looking for 1 to 2 weeks of sell pressure. Okay, we've already gotten 1 week in for the S&P, meaning next week could still be a little bit bloody if we do not hold that support. Okay, so this is not only something to help you make money short term, but it's also a little outlook for the upcoming week. If we don't hold that support, the S&P goes for another puke down. Okay, but again, the method just combines moving averages and price structure, which can be simplified to support and resistance. If you're not used to volume by price, then practice with it a little bit, get used to it, look up some more videos on it. We got more on the website as well, tradewithtex.com. But that's how I use this method for spotting potential bigger pullbacks in the markets. Okay? Either way, you guys have a great rest of your weekend. Hope you enjoyed the video. Like and subscribe to the channel if you have not yet, and have a good one.